All right, so today we are going on a deep dive into the Indian stock market
Okay.
using a recent newsletter from Volatility Coaches of India. This is dated March 2nd, 2025.
Right.
And they seem to provide some guidance and insights for investors.
Yes.
If you want to get a handle on what's happening in the Indian market.
Yeah.
So let's just jump right into it.
Okay.
So the newsletter starts off by saying that the NFTY 50 index is standing at 22,124.70 on March 2nd, 2025.
Okay.
It also mentions that it dropped 1.86% compared to the previous week.
Right.
So what's the story here?
So the NFTY 50 represents the top 50 companies in the Indian stock market.
Oh, okay.
So it's a benchmark of the Indian stock market performance.
Yeah. Mm-hmm.
So a 1.86% drop, that's significant.
Yeah.
But it's important to remember that the stock market fluctuates daily, weekly, monthly.
Okay.
So it's just a snapshot of what happened in that particular week.
Mm-hmm. So the newsletter also mentions all these other parameters like PE, PB, market cap to GDP, RSI.
Right.
It's a lot to take in.
These are key financial ratios and indicators that are used to assess the valuation and the overall health of a market or a specific company.
Okay.
So each of them provides a different perspective on market conditions.
So let's maybe start with the PE ratio.
I'm not sure.
So it says that the PE ratio for the NFTY 50 is 19.67.
Right. So the price to earnings ratio.
Right.
What it does, it gives you a sense of how much investors are willing to pay for each rupee of earning generated by companies in that index.
So in this case, 19.67.
Right. That means investors are paying 19.67 for every rupee of earnings.
Okay, and that can help us understand market sentiment.
Right, exactly.
Okay, what about PB? It says it's 4.14.
So PB is the price to book ratio.
Okay.
And that compares the company's stock price to its book value per share.
Mm-hmm.
So it basically gives you an idea of how much investors are paying for the net assets of a company.
Mm-hmm.
A higher PB ratio could indicate that investors have high expectations for future growth and earnings.
And then we've got market cap to GDP. That sounds pretty important.
It is. So market cap to GDP is also known as the Buffett indicator, and it compares the total market cap of a country's stock market to its gross domestic product.
Okay.
And it basically gives you a sense of whether the stock market is overvalued or undervalued.
So if the stock market is high compared to the GDP, that means it might be overvalued.
Exactly.
Okay. Now I'm noticing that this RSI thing had a pretty big drop.
Yeah.
From 65 the previous week to 41.39 this week.
So RSI stands for Relative Strength Index.
Okay.
It measures the speed and change of price movements to evaluate whether a stock is overbought or oversold. Typically, an RSI above 70 is considered overbought.
Okay.
Below 30 is considered oversold. So a drop from 65 to 41.39, that suggests a shift from a potentially overbought zone to a more neutral or even a potentially oversold zone.
Okay, interesting. Now, here's where it gets really interesting for me.
Okay.
It says that the FII net open interest change is negative 10,720 CR.
Gosh.
That's a really big number and way larger than the previous week.
Yes.
What is this telling us?
So FIIs, those are foreign institutional investors.
Okay.
And these are big players in the market, like hedge funds, pension funds, mutual funds from other countries.
Okay.
Now, net open interest, this refers to the total number of outstanding derivative contracts held by FIIs.
Okay.
So a negative change in FII net open interest, it could suggest that FIIs are reducing their positions in the Indian market.
So is that a bad sign? Like, are they pulling out?
Well, it could be due to various factors.
Okay.
It could be profit-taking.
Okay.
It could be concerns about global economic conditions. It could be specific concerns about the Indian market.
Okay, so a lot to unpack there.
Right.
All right, so they have a notes and observations section.
Okay.
And it says, below 22,000 nifty levels, buy more equity in a staggered manner.
Okay.
And include a multi-asset strategy.
So buying equity in a staggered manner, what that means is basically you're not investing all your money at once. You're spreading out your investments over a period of time.
Oh, okay.
So you can average out your costs and reduce the risk.
So if it drops below 22,000, they're saying keep buying, but just don't buy it all at once.
Exactly. Spread it out.
And what is a multi-asset strategy?
So a multi-asset strategy involves investing in a mix of different asset classes.
Okay.
So it could be stocks, bonds, gold, real estate.
Okay.
The idea is to diversify.
Right.
And reduce the overall risk.
So don't put all your eggs in one basket.
Exactly.
Okay. And then it says, the lower we go, convert flexi-cap to multi-cap funds. And then it says, current focus, large cap funds and hybrid funds.
Okay, so flexi-cap funds and multi-cap funds.
Yeah.
Both of those are equity mutual funds.
Okay.
But flexi-cap funds have more flexibility to invest across market caps.
Okay.
Whereas multi-cap funds have to have a certain allocation to large, mid, and small cap stocks.
Okay. So if the market's dropping, they're saying shift to those multi-cap funds.
Yeah.
Okay. And then what about large cap funds and hybrid funds?
So large cap funds are funds that invest in companies with a large market capitalization.
Okay.
Typically, these are well-established companies.
Yeah.
Considered to be relatively stable.
Okay.
And hybrid funds are a mix of equity and debt. So they offer a balance of growth potential and downside protection.
Okay. And to top it all off, they give us some specific sectors to watch. Current sector, focus banking, finance, IT, and pharma.
Yeah, so they're saying focus on those sectors, potentially because they see those sectors as having strong growth potential.
Okay.
Or maybe they're undervalued at this point.
All right. This newsletter has a lot of information.
It does.
I think we should take a quick pause and then we'll come back and dig into the rest of this.
Sounds good. So welcome back to our deep dive.
Yeah, we were starting to look at all these trends before the break.
Right.
And trying to understand how to use those to our advantage.
Yeah, so they're basically giving you a timeline of market trends.
Yeah.
Highlighting when the market was up, down, or maybe just kind of sideways.
Okay, so like historical trends?
Exactly.
Okay.
So this gives you an idea of how the market has reacted to different things in the past.
Okay.
Like economic conditions or events.
So understanding those past trends can help us to make better decisions in the future.
Yeah, history doesn't always repeat itself perfectly.
Yeah.
But it often rhymes.
Right.
So by looking at how the market's behaved in the past, you can maybe start to anticipate what might happen in the future.
And they give us an India VIX value of 13.91.
Right.
So how does that translate into real-world decisions?
So remember, the VIX is like the fear index.
Right.
The higher the number, the more nervous investors are.
Okay.
They expect bigger price swings, more uncertainty.
So 13.91, is that high?
That's actually a relatively moderate level.
Okay.
But it is worth noting that it's down from the previous week.
Oh, okay.
14.53 last week.
So maybe things are calming down a bit.
Well, it's hard to say for sure.
Okay.
We need to look at it in context with all the other indicators.
Right, right. No rash decisions. This is not about chasing some hot stock tip.
No.
It's about understanding how things work.
Exactly. It's like understanding the underlying forces that drive the market.
Okay. Now, there's this whole sectorial index table with a ton of data.
Yeah.
What about these PB ratios? What does it mean that the Nifty Midcap 50 has a PB of 4.9?
Okay, so the PB ratio, it compares a company's market value to its book value.
Okay.
Which is basically the value of its assets on paper.
Okay.
So a higher PB ratio could mean that investors are willing to pay a premium for those companies.
So why would they be willing to pay more?
Maybe they expect high growth.
Okay.
Or maybe they see a strong brand value.
Okay, so like the Nifty Midcap 50 at 4.9 compared to, say, the Nifty Small Cap 250, which has a PB of 3.2.
Right.
So is that a big difference?
Well, it's all relative.
Okay.
Different industries have different dynamics and different growth cycles.
Okay.
So the key is to compare those PB ratios within the same sector or industry.
So a high PB in one sector might not be high in another sector.
Exactly.
They use terms like negative trend and positive trend.
Okay.
I'm kind of getting a feel for what that means, but could you maybe break that down?
Yeah, imagine like riding a wave.
Okay.
The market's going to go up, it's going to go down.
Right.
Sometimes it's just going to stay flat.
Okay.
So when they say negative trend, they mean the market is heading down.
Okay.
Prices are falling, investors are probably a bit gloomy.
Right.
And a positive trend means the market is up.
Okay.
Prices are rising.
Right.
There's a lot of optimism in the air.
Got it. They also mentioned a neutral trend. What's that?
So that's when the market's kind of taking a break.
Okay.
It's not moving too much in either direction.
Okay.
Like it's just catching its breath before the next move.
Right. So if we think back to their investment advice about, switching between different types of funds.
Right.
It sounds like they're saying be more conservative when it's negative and bolder when it's positive.
Right, yeah. Investment strategies often need to adapt to the current market climate.
Yeah.
So when you have a negative trend, you know there's a lot of uncertainty. Investors might want to prioritize protecting their capital. So they might look at more stable options like large cap funds or hybrid funds.
Right.
But when the trend is positive, they might feel more comfortable taking on some risk.
Right.
And they might go for higher returns. Like mid-cap stocks.
Got it. So how do we actually know what the trend is? Like, is there a specific way to determine that?
That's where technical analysis comes in. Technical analysts use charts, patterns, and indicators to identify trends and try to figure out turning points.
So like a whole other level of analysis.
Right.
They give us the expected economic growth of India at 6.86%.
Right.
And a dividend yield of 1.5%.
Yes.
What's that telling us?
So a growth rate of 6.86%. That suggests continued expansion. Which is good for businesses and, by extension, for the market. A dividend yield of 1.5%. That shows companies are giving back some of their profits to their shareholders, which could be attractive to investors who are looking for some income.
So if you had to pick one thing for our listener to really pay attention to right now, what would it be?
I think the interplay between domestic economic growth, global market trends, and FII activity.
So are things looking good for India?
I would say cautiously optimistic. But yeah, it's a market that's still growing.
All right, we've covered a lot of ground.
We have.
I think our listeners are well equipped to not just understand this newsletter, but also the Indian stock market.
Those two.
But we do have one more part of the puzzle to look at in part 3.
Welcome back to our deep dive. We've really gotten a great handle on the Indian stock market, haven't we?
Yeah, we've uncovered so much from just this one newsletter.
Absolutely. And you know me, I've saved the best for last. There's this section called RVCC Parameters and Conclusions. Things like the Nifty Small Cap 100 and Nifty Mid Cap 150 are positive.
Right.
What's going on here? Is this like their secret formula?
It seems like this is where they apply their own special framework. Oh, okay.
You know, it's probably based on their Rebalance Volatility Certification course. Like their secret sauce. They're saying small and mid-cap indices are looking positive, which suggests those parts of the market might keep growing.
Even if the rest of the market is a bit shaky.
Exactly.
So there are always bright spots.
Right. Each analyst or firm has their own special way of looking at the market. The important thing is to understand how they reach those conclusions.
Don't just follow blindly.
Exactly.
You have to think for yourself.
Right. Think about your own goals. Your own risk tolerance. And how you see the market.
So as we wrap up our deep dive here, what's the main takeaway?
I would say the Indian stock market is full of opportunities. But also challenges. There will be ups and downs.
It's like a roller coaster.
Exactly. Calm times, volatile times.
Right. You've got to be ready for anything.
The key is to stay informed. Do your research.
Absolutely.
And keep learning.
We've definitely learned a lot today.
We have.
From all those acronyms to different ways to invest and even a glimpse into India's future.
It's exciting.
It is. I think our listener is ready to take on this market.
Yeah, definitely.
So to our listener, we say,
go forth and invest wisely.
Invest wisely.